take the energy doesn't seem so. So better off with a mic.
I think they are recording.
They are recording? Okay. I think before we begin this session, Friday morning, attending the boring session of customs, transfer pricing, I don't know what relevance it has. To make it a little interesting and reduce the agony, let me narrate a small story. And the story is about green world. Has anyone heard about it? Green world? It may not be, I think it's a very old story. So I was going through several things preparing for session. I just embarked upon it. And the story is about, there was a very rich man. And he suddenly developed a pain in his eye. It was unbearable. So therefore he consulted galaxy of the doctors to help him overcome his pain. But unfortunately, a lot of them tried. Nothing worked out. And his pain day by day increased. So there was a monk, and he was known to treat any ailment in the body very well. So this, as soon as the gentleman came to know about it, he reached out to this monk. And he said, this is the pain is getting unbearable and all. Monk understood what it is. And he realized what's the problem. So he said, I have got a solution to your problem. But you got to follow it religiously. He said, fine, I will do whatever. I just want to overcome this problem. Great. So what solution this monk gave is make sure that whatever you see in green color. Don't let your eye fall on any color other than green color. If you do this religiously, I guarantee you that your pain will vanish. So very strange. But since he was in great trouble, he had no option but to adopt it. And as soon as the monk left, he instructed all his people that make sure everything in the room which is there, wherever I get to see, is all painted in green color. Everything, be it table, chair, his bungalow, everything green color. So I want to make sure that whatever I see has to be green color. Great, suddenly it worked. And his pain reduced. Maybe after 2 months or so, monk was again passing through the same area. He thought, let me go and check with this man what has happened. So as soon as monk entered his bungalow, one of the servants came running and he poured a green color on the monk. The monk was surprised, what are you doing? No, my master has advised me that whatever he has to see has to be in green color. So please pardon me, but if you are going to meet my master, then sorry, you will have to be dressed like green color. I cannot let you meet him in a red color dress. He started laughing, and then he met the master. He said, how is the pain? The pain has reduced. But what have you done? You have changed everything to green color. How much money have you spent? He said, I have spent $1 million in this. Oh God. Had you only bought spectacles with a green color, you wouldn't have to do all these things. By changing the entire world, you should only change your vision. You wanted to see everything to be green, you would have wear the green spectacles. Why you had to change the entire world? Isn't it? And you would have saved $1 million and so much of pain and trouble. I think same applies to us also. We want to see the world the way we want it to happen, not the way. In fact, if we change our vision, our perspective, then things become so different. Isn't it? Rather than trying to see that what should change for me, I should change my perspective to it. So, while the session is boring, now we don't have option. For next, whatever, hour and a half, we all are here. So let's make most use of it. I have two options. Either I will have this very dull slides which I will walk through, and I will say something, you will hear something, and I will go and you will go. Or second option, I will make it very interactive. I will share a lot of things. I am here to learn a lot of things from you, and it can only happen if both of us share. So while the slides are there, I am committed. I will complete the slide. But at the same point in time, I want you all to share whatever little experience you have, so that all of us in this room learn from it. Yeah. So let's begin with this. This is what we are going to cover. A very interesting aspects, I think. People who never got used to so people who don't have much of the, how many of you are not aware about the customs over here? Just raise hands. Not much aware about a custom, not practiced anything on customs. I presume rest who are not raising hand are aware of customs. Including myself, I don't know much about customs. Yeah. So the rest who will not raise their hands are going to teach us about a custom. Okay. We're going to talk about a similarity, dissimilarity, how the customs and transfer pricing law converges. What are the practical issues faced on ground by customs authorities while facing customs and transfer pricing authority, and what should as a taxpayer or as a consultant we should do. Now while I was yesterday preparing beside this story, I said what is that I want to leave with you while this session is over. So the 5 questions came to my mind and I just listed down those 5 questions. So maybe while we end the session, I hope that all of us over here should be aware about a response to these 5 questions. Will the convergence between the transfer pricing and customs will be beneficiary? Are the methods in customs and transfer pricing similar? Does the taxpayer has to adopt the same method to justify arm's length nature of transaction for transfer pricing and customs? Can there be situation where both customs and transfer pricing authorities make adjustment in respect of same transaction? And can taxpayer place reliance either on transfer pricing analysis or in customs analysis while representing before both the authorities? These are the 5 questions probably I hope to clarify through the presentation as we walk through. So typically a multinational which is importing a products in India has a very unique challenge of marrying customs and transfer pricing. And the objective of both the laws, as you all must be aware, are very different. While the path they take is different, but the aim or the destination which they aim to achieve is common. And this problem is not just with us. The problem is with almost all the countries across. In fact, recently we were talking to a couple of our overseas countries and to see that we were doing some analysis on the customs convergence. And to my surprise and my dismay, the situation is not very different. You talk about US, you talk about Germany, you talk about Switzerland, almost everywhere there is same thing. In fact, UK they have done one great thing. There is only one common body, HMRC, under which their customs and transfer pricing both are housed. But still they are struggling because both the authority, even though they are under one, and today we have a central CBEC, CBDT, are 2 different bodies in that sense. Though they may be reporting it to the CBDT, but then there are 2 different bodies, and in UK they have converged and made it under the same body, but still there is not much of the convergence, not much of the exchange of information, which is very surprising in a mature jurisdiction like a UK. So the story is not very different. So while we are maybe I think 30-40% in terms of a convergence, in UK or it's not 60%, but not there, but they have a way to go to marry both the law. For these slides, in fact, explains things in a great manner. So what are the objectives? The objective of custom is to increase the cost of goods, and the objective of transfer pricing is to reduce the cost of goods. Different law, different focus, time period, very essential. Today if you want to converge both this law, then the time period has to be the same. In customs, once you obtain a SVP valuation, it's valid for 3 years. Then for 3 years you don't have to go and again see the custom authority unless the pricing mechanism changes. But in transfer pricing, post facto, every year the assessment has to happen when even every year he is going to reassess the transaction value of the goods. So while there is an annual scrutiny, vis-a-vis there is a 3-year scrutiny, 3-year beforehand they do the analysis and come out with the STP valuation. Very importantly, in customs they are only going to deal with tangible product, which is the goods. While in transfer pricing, everything like goods, service, anything and everything will be there. In fact, very interestingly, suppose if you take a software as an example, and software, if I was to get it in a CD, I pay custom duty. But if it's not getting the CD and I download it, what do I pay? Sorry? So if software comes in a CD, I pay custom duty. But if it doesn't come in a CD and I directly download it, service. So the mode of delivery makes a difference. And today, being in a digital world, everything is online. So the big problem, how should we tax, what should we tax? Today is embedded software, not embedded software. How much of more complex? It's very interesting. As you get along and you kind of see both these things very closely. Unfortunately, in reality, the people dealing with the indirect tax and direct taxes are different in the industry. And that's why many times I've seen the difficulty happen. The person who indirect tax would not know what is happening in transfer pricing, and this guy would not know what is happening in customs. And there are different submissions have gone to both authorities. He is saying that this method is right, he is saying this method is right, and there is, if you look at both the submission and you say, oh, what are you saying? Are you talking about the same client, same company? It's amazing. Again, if you just talk, there is so much of communication gap, and all the problems largely arise because of the communication gap and lack of awareness how on ground things are happening. Very simply, I think you guys are now expert on transfer pricing, having attended so many sessions. So very briefly, it is to deal with cross-border transactions where it's a year-end exercise. The objective is to justify the arm's length transaction. While in some countries there are domestic transfer pricing, in India also now we have a domestic transfer pricing which is applicable. Now that is causing a lot of pain and agony, because while the concept is right, but today the way they are implemented, they are trying to cover directors and all those things and the managed remuneration, but there is a lack of clarity as to how to benchmark those transactions. And I think first round of audits are going to happen in this year when domestic transfer pricing is introduced. It's going to create a lot of another kind of Pandora's box. For those who are not practicing customs, or those who are not going to come across this, maybe I think first time that you are seeing these rules after your CE exams, while you may have briefly seen it. Very interestingly, look, there are rule 3 to 9. This is the only crux in custom valuation. There is nothing beyond it. If 3 to 9 you are aware, then everything is covered in that. And conceptually, it is very logical rules. They have to be followed sequentially, one after the another. So what does the rule 3 says? Rule 3 says if you are able to find an identical product, then same price should be taken, which is very similar to, again, transfer pricing. If you are able to find a cup, then same should be followed. If it's not an identical product, but a similar product, okay, let's do an adjustment. And then we work out the price and we come with the price. Fine, that's also possible. Rule 4, very minor distinction between rule 3 and 4. Rule 3 where there is the internal cup available, rule 4 when there is external cup available. Rule 5, again if there are what adjustments are there, once you have an external cup, you make adjustments to that. Rule 7, like a resale price method, you take an ultimate customer price, reduce from that whatever distributor margin, then you come out this thing. Rule 8 is a computed value. You take an overseas entity's cost, which is the cost plus method we use in transfer pricing. And rule 9, if you are not able to follow any of these things, then you are at the mercy of the officer to do things. So very similar to what transfer pricing law is. It's fine. Going into a little more detail as to in customs law and transfer pricing. I think before we talk about the conversion, let us understand what are the fine nuances which is there, which may be critical in terms of eventually if you want to convert both these laws. Very importantly, the threshold for qualifying as a related party in a transfer pricing is 26%. While you talk about the custom, it's only 5%. So anything and everything under the sun is falling in as the ambit of related party transaction. Now I am very interested to show you, in a custom there is a enters in India, or suppose when the importer is going to import, there is a CNF agent who appoints. He, before while the goods are entered, he has to do a GAT declaration. The GAT declaration, he has to say whether the goods which are importing is from related party or no. If it is from related party, then the officer subjects it to the special valuation branch officer to do a SVB. In a SVB, there are 29 questions which he needs to answer within 30 days. When these questions are answered, before the SVB is concluded, and if you are importing the goods, you do a provisional assessment where whatever the goods are coming in, you pay 1% revenue deposit. You pay continuously. If today the officer does not agree with your price, then the price from 1% can become to 5%. And this is real pain area for a lot of gamers. Today, one single pain area where you see is before getting SVB valuation, if you are not got it right at that point in time, you lost it. Huge cash loss, huge cash. Today we are having a numerous of cases where we are before the appellate level or tribunal trying to litigate and justify, hey look, this cannot happen. And if you look at this question, it's not very different from what the question the officer is in a regular income tax scrutiny is going to ask you. Very similar, but the responses which goes to this, and when you see the response which goes later on, you yourself feel like very difficult to manage this fact. So here is like point 7 where they will ask whether any foreign suppliers or associate enterprises jointly or severally hold more than 5% of equity. Now practically we don't dispute this because in a group company scenario 5% threshold breaching is not very difficult. It's going to happen every time. So therefore this is the most least litigated point. Whenever there is a group company transaction, definitely it's assumed it's the related party and we go ahead with that. This is a point very relevant whether the importer is a sole agent, distributor, indentant or appointed by a foreign supplier. I will cover in the presentation why this point is very important. These are the very small, sweet but very difficult questions to answer. Is the price list with discount? Is it net discounted price? It is the quotation and how the transfer pricing is done. So upfront before your goods are going to enter, you are going to state all these things to customer. And the same questions in your transfer pricing documentation, you are going to answer it. Okay, so we spoke about the larger threshold in transfer pricing and narrower threshold in a custom, due to which the ambit of both the area related parties to be covered is larger. So today, if you want to converge, I think first important thing you need to get both these threshold right, so that then your applicability is restricted to the common entities. Transaction and scope. Transfer pricing applies to everything. Applies to goods, applies to service. Customs applies only to goods. We spoke about a method. These are the 5 methods which are listed over here, and there are 5 methods which are listed in a customs. This slide is very important. Hello. This slide is very important. If there are more than one prices, in transfer pricing you take a arithmetical mean. In customs, if there are more than one prices, you take lowest of the price. Does it ring a bell? Today if I am importing a laptop and if there is a simply we say that the laptop is taken, my import price is $100. There are 5 other laptops at that point in time imported by me or by third party. Price is 110, 120, 130, 150, 160. So how it will happen in transfer pricing? Can anyone say me how it will happen in the example? Today if a price is 110, 10 to 150, and let's take an average of that is coming to 125. So in transfer pricing what price you will take? 125. In customs what price you will take? 110. So whatever the lowest of this. In transfer pricing there is a plus minus 3% variation. So while they may try to say that by giving the variation range you are falling in, but then still there is a conceptual basic differences between both the law. Unless these are addressed, there cannot be convergence. We are talking about a convergence. The convergence to have to happen, both the law need to match. And these are the fine nuances. First we spoke about a related party, the threshold. Second we spoke about the on what basis the comparable price needs to be taken.
Bhavesh, for the purpose is to levy the custom duty, why they are taking the lowest price, why not the highest price?
Theoretically, what is written is right, but practically they take always a higher price. So while it was surprising where the purpose of this is to take a highest of the price, by the law which is written over here, but today we go and talk to any revenue officer over there, he is anything, low price is comparable nahi, I will go with a high price. So the way this law is worded, but unfortunately in practice, only high price is being taken.
But there are no precedents for this, when the law is so clear.
There are litigation, lot of litigation for lower level officer it's so easy, no, I don't agree, this is the loading I want to levy. Now you continue to fill. And again with the customs, unfortunately, today the representation in customs happens largely through a CNF and not through more of a professional. And I think that's why there's a one area that really needs to come out of it. And today really I have seen a lot of clients who go through CNF agent are able to get their SCB quickly. And if they go through a normal route and hire some professional and do things, or lawyers and all those things, they really struggle in getting things right. This is the one area in Big Four also, SCB valuation you will see today in our indirect taxes team, least work we will be doing on SCB valuation. We will do all help out, review and all, but to face these officers and to kind of get this thing done is unfortunately, there is a lot needs to be improved over there. Documentation more or less similar, so documentation is not a pain point. Adjustments. There is no specific adjustment which is there in transfer pricing. You can call for a working capital adjustment, you can call for the risk adjustment, so on and so forth. But in customs, they have laid down what adjustments are there. So today, if you are taking a resale price, the commission of the broker, the distribution margin, so they have set what kind of adjustment need to be taken in a customs.
Are these pre-prescribed, or I mean the rates, or is it dependent on actuals?
No, so it depends on actuals. Only their methodology they are pre-described. So today, if you are going to take, I'll show a very interesting example. I was working on one of the company which is trading of pharmaceuticals. So what happened is before the company was here, they were operating through a distributor. And when they were operating through a distributor, the product, suppose say product X, the product X they were supplying at 100 rupees. On that they used to give 24% margin to the distributor. So while and then they started to do their own entity. So let's take example 100 minus 24, the value comes out to 76 rupees. That was the price which distributor had for the product. Now when they said that I want to start my own business or own subsidiary, obviously when you want to start your own subsidiary, you want to have your own cost. Initially the volumes are not going to be high and you don't want the subsidiary to incur losses. So you do a backward working. Okay, in the first year I expect 1 lakh quantity to sell. Price of this sale is 120. This is the cost of the entity's operation. This is how the margin is there. This is the other amount. So eventually to enable the entity to earn a decent margin, I need to supply the goods at a 60 rupees. Now when this matter came before the customs, it is absurd. When you are supplying to a distributor, supplying to 76, and when you are supplying to your own subsidiary, there is 60 rupees. So clearly this is suppression. This is done to suppress the customer. The customer objective is what they want. Their duty is dependent upon the price. So today, same product, when you are supplying to a distributor, you are supplying at 76. When you are supplying to your own subsidiary, supplying at 60. Now what could be justification? Why the price? And we were able to succeed. We were able to succeed, show, demonstrate why 60 is right here, why 76 is right here. Can anyone think about it? What could be the justification? Why 60 was right when you are buying as a distributor, as a subsidiary, and why 76 was right when you are supplying to distributor?
Because the distributor will have to restrict his margin. So as you said in your example, 24% was the margin. The rest everything was kept by the parent company or the foreign company. So when it's a model where they are setting up a subsidiary here, certainly I am here to do business. So that 24% of element, I have to consider the cost element actually, what is embedded in that. And I have to consider the local cost also, because certainly if I am importing on my own, say after setting up a subsidiary, I have a supply chain cost, the whole supply chain of cost to really incur.
Yeah.
So to consider into cost, I have to really bring down the 70 rupees to 60 rupees, because that's it. The differential is towards the cost, supply chain cost.
Correct, correct. Anyone want to supplement, add any arguments? Has anyone understood what he said?
Well, as a distributor, I mean, you will not be participating in the brand building exercises, so A&P cost would also be a part of the thing.
Wonderful point. Very good. Yeah, yeah, yeah. Any other argument? Why a subsidy 60 rupees justified, and why distributor I am paying 76? And customers are going to lose the value only. So one is the cost. Definitely, when I am going to enter my subsidiary, my business model is different. So first of all, there is a difference in the business model. Second, as she rightly mentioned, A&P expenditure. Third is the volume. So we were able to show a project when I am going to do the distributor. Over the next 5 years, my expectation is that I will earn 10 lakh units. But when I am setting up my subsidiary, that 10 lakh is going to become 50 lakh rupees. So look how much we are going to make money in customs by doing that. And today if I supply at 76 is a no-brainer, no starter. Because if I have 76, if I add the local cost over here, then that's the price I'm not going to get it. So if you want me to stop the business, great, I will close my shop and go back and do this activity. But today if you want me to really be serious about it and do this business in a more intense manner, then you need to allow me 60 rupees. There was a lot of to and fro, because at front, tax authority is a mindset, they will not accept all this. Yeah, everyone comes and says so. But how much more stronger the documentation you are able to build and show, there's so much of commitment of revenue, there's so much of commitment of the quantity, here are the confirmed orders which we have, here are the workforce I'm going to employ. So much justification. And fortunately, after all justification, we were able to sail through and convince 60 rupees is the right price. There were, but what really mattered over there was, having your documentation and arguments right at the first place. That's somewhere we lack about it. You try to hide things. Don't say full over here, say half-hearted over there, and then today, fortunately, both the authorities are not talking. But the day when they're going to start talking, I think existing issues, they're going to have so much of problem. I've seen so many times in customs, you have gone ahead and justified cup as a method. Because what happens? You are importing at 100, there are 10 other prices you saw, which is in the range of 80, 75. So your price is higher. Simply say for you to easy way out is say cup is the right method. And you come out of it. Now what happens? When you come out of it and you show the same thing to transfer pricing, what transfer pricing office is going to do? When you show a cup, you are buying at 100, the third party price is 75. What the officer will do over here? You overpaid it. A strong argument for you to justify transaction in a custom becomes the weakest of arguments. A strong method in custom becomes the weakest of the method. But how do you do it? How do you overcome it? Today, if you are starting up an entity where there is a full-fledged cost is going to be there are hardly any volumes into it, there is no profitability you can project and show in a first year, then how do you justify in a custom? Just think about a practical challenge. A startup company which is just going to start an operation, it's got a huge cost. So profit-based method is never going to work over there. Only price-based method is going to work. And the price-based method, what is going to work, you are different. It's impossible to find a price which is 100 to 100. So you're always going to find a lower price. The easy way out in a custom, that time people are excited, I want to get my SPB out. Let it be a see transfer pricing later on. What happens? Let's get our SPB out first. And whatever you said in SPB, today, if simple question in a assessment, the officer start asking, give me a SPB, or what basis the officer has accepted a price. We have do nothing. There is nothing, no play with comparable. Just simply taking your own submission and he can hit you hard for it. And then you cannot come out of it. I covered several case laws on same very point, how one needs to plan it out and how one needs to do things. So SPB, any verified transaction compulsory will go to SPB. In a transfer pricing, if the value is 15 crore, then only it will be subjected to specialized scrutiny. Penalties are more or less, I think, similar, not really true. An important slide. One is going to push the value up, one is going to push the value down. And the taxpayer in between is caught. So there is tug of war going on, and you need to balance out which way you want to be. Moment you are on this side, then you are going to upset this authority. If you go to step on this side, you will upset this authority. Therefore, it's very important that you stay balanced, you stay in between. You don't get trapped in either of the directions. How the methods are similar in both. So what we call is arm's length price is called as transaction value over there. What is the cup? It's called identical goods, similar goods, resale price, deductive value, PNMM, computed value, profit split, fallback method. There's nothing more than that you need to know about customs. This slide summarizes everything. So the answer to the first question over there, are the rules similar? The rules are similar. What is different? Application is different. And who is complicated? We are only complicated. Otherwise, methodology is same, paths are different, objective and aim is same. And many times now, we take argument which suit us. Yeah.
Participating in the REACH method, there are very detailed rules.
Correct.
Whether under customs also the rules are similar?
Yeah, so rules are more or less similar in terms of wordings and in terms of detailing. In fact, customs is more granular. More granular, identifying the items like when we say deductive value, brokerage commission should be reduced, this should be reduced. That in transfer pricing only they say adjustment should be done. But then they have identified the items also. And so practically how really happens in custom when you go for FCV valuation, first you try to, officers will always start with, they have a tips database. They will start with the database taking 10 products and then throwing up to you, saying your price is high, this price are low, why should I not go loading? Then you start for justifying, rejecting each of the transactions. Then you come to deductive value. So for me the simplest thing what I have data in my hand is ultimate resale price what I am going to get. If it is an MRP based product, life becomes very easy. 100 rupees is the MRP, 20% distributor margin, 10% my cost, and that's what the cost is there. So 90% of the cases, deductive value is used in customs. In transfer pricing, TNM is used. Resale price will never use it. Lot of time the officer will ask you, no, I don't want to go deductive value. I want to go with computed value. What is computed value? You show me margins of overseas entity is making. And then why would I reveal it? Why would they reveal it to you? I don't want to reveal it. What is the discount that they are giving it to you on list price? In Asia Pacific region, show me other entities. What discount they are giving? Are they giving a highest discount, lowest discount? What discount are they giving? Why should I reveal it? I don't have the data. So a lot of time the challenge comes when officers will always try to see what favors them and taxpayer will try to, because that info is not available and are not supposed to say what overseas entity is making unless sometimes there is also a situation where you say so, but largely it's deductive value is what goes on customs as justification.
In TIPS database, do we get the complete data about the quantity of the product and various other factors which are so important for cup method? Yeah,
so there is. In fact, there is one of the cases which I am covering where the tribunal upheld the validity of TIPS database. The transfer pricing officer rejected it. Tribunal said, no, TIPS database is right database. Why should it not be taken? It is giving you third parties what price they have bought on that day. So TIPS database is the right database. In fact, recently they have stopped, but earlier the officer, all transfer pricing officers had installed TIPS database in their company. And whenever you go and say there I have a trading entity, immediately they will type out the product, give you a list of 10 things. Why should this not be taken as a comparable transaction? So they have, but really I think they realize somewhere what they are doing is not right, because again today if you are buying a switch gear, in switch gear also there are thousands of varieties. So today what part number, what serial number, to get exact comparable is different, but what the quantity, date, party, price, everything is there in TIPS database. So this is a poster and very, I think, here the case went against the SSC. The SSC is engaged in import of coal. And this is a classic case how people try to manipulate and show things which favors them. So SSC is engaged in importing coal. During the year, SSC imported coal of 1000 metric ton at a $46 per unit. The transfer pricing officer did a search and he found out on the same very day, 43 price somebody else is buying. Why are you buying at 46? So on the same way, TPO found Adam Coal and Resource has bought 1440 quantity, larger quantity as per economics transaction, higher the quantity, price will be lower. But he has bought at a 1440 metric ton of coal with 43 as a per metric ton on same day. So if you rely on custom data, then clearly you have to done underpricing. And you have done underpricing, and I am going to make an addition of 34 crores or 3 crores to your transaction. Is it clear? Taxpayers valuation obtained by TPO from custom authority. Valuation of customer need not necessarily be realistic, as the department is more interested in collecting the import duties. What did tribunal say? Custom valuation not arbitrary exercise but based on scientific formula method. Therefore, custom valuation cannot be discounted. Price other than custom valuation may be considered arm's length if proper documentation maintained. Tribunal ruling, stock method can be adopted on basis of custom valuation. So in this case, tribunal accepted what officer has done. He said 46, what you have done is right. So taxpayer has lost a case in tribunal. So what is the learning in this? The learning in this, the tribunal while the judgment very clearly made a finding. You are saying 46, he is saying 40, you are saying 43, he is saying 46, right? So on the face of it, this is a pole, this is a pole. While we accept and appreciate, in coal there is something called calorific value. So the coal depends upon calorific value. Higher calorific value, the price will be higher. Lower calorific value, price will be lower. So you distinguish and tell me, the comparable which is taken is of higher calorific value and your is lower calorific. If you show that to me, then I am going to accept your contention. But taxpayer was not able to demonstrate or did not choose not to demonstrate. If you choose not to demonstrate it, merely putting a qualitative argument, you both are not comparable, then why they are not comparable? So today there is definitely something more, he is going to hide something, which is why before tribunal he chose not to get into the specifics of the product, saying why these products are different qualitatively. Since that was the taxpayer chose to do that, tribunal had no other option and tribunal accepted what they did. So very unfortunate, but this is what really happened. Because in fact, other case which I want to now quote over here. Yeah, sir.
Always what happens in the case of long-term supply contract, in the case of commodities, we give example of coal. When somebody is making arrangement, long-term 5 year, 10 year, linked to some index, linked to inflation adjusted, and makes all the arrangement for evacuation of coal.
Yeah.
And then the perhaps he can get a cheaper price from the supplier. Because he is making a long-term arrangement, he is making all the arrangements for evacuation.
Correct.
So in such a case, what is the issues in the customs and transport?
So there is a tribunal case law in Fuchs, similar thing. So what they try to do is they try to compare the price on the date of import. And taxpayer said on date of import, you cannot compare the price. What you need to compare is the price on a date of contract. So today, as sir rightly said, 5 years ago I made a contract. On that day what price was prevailing, same price should be taken. On the date of import, you may have 10 other things. I may have some arrangement, I may have given advance, I may have given a commitment of quantity due to which I would have got a favor. So what you need to compare is the contractual terms and not on the date of import when the landing or shipping is happening, what's the price in this situation. So in that case, the tribunal rejected, the officer had made addition based on date of import, tribunal rejected and said date of contract should be taken. Even in customs, when I think if you put up this fact properly and you say that on the date of contract, this was the price and ultimately this was the London Stock Exchange you take or this was the MCX you take and this is the commodity price and this is how the adjustments worked out, I think they are done. In fact, I was doing one case of sugar. In sugar, we had there is a sugar, there are different ports. Suppose there is a port in Gujarat, there is a port in Madhya Pradesh, port in this thing. So the price of the same sugar, again there is a color which matters over there. If you take a price of Kolhapur and price of Gujarat, the price was different. Why? Because also besides there is a port, I also have to incur the transportation cost. So when we are able to put up this thing properly, it was accepted. So accepted in customs, accepted in transportation both. But I have personally not encountered this situation of 5 year long contract, how you are going and dealing with customs authority. But whatever my experience has been, if you are able to show with a comparable data and if he is not able to demolish that data, then you get accepted.
So basically, you need to have very well documented business decision.
Perfect. I think that's the key. Your documentation at the inception has to be very well reasoned out. And the result should not be chosen to meet the short-term goal. It should be chosen, even if in short-term it is adverse, to look at long-term. Okay, what would, if a transfer pricing officer or a tax authority is going to look at it, what are they going to infer and read? But unfortunately, in my career of 10 years, I have not more than 5 to 10 cases I have come across where people are so diligent at the time of customs they will get their transfer pricing guide, or the time of transfer pricing they will get their customs guide. It's a different Chinese wall is there, different people are doing things, they are living in their own world and they are doing things in the way they suit the best. And that's the real problem. There is a contrary submissions, contrary arguments, contrary documents. In fact, no sense of what happened 2 years ago, no people change hands and everything is lost. And therefore, it's very important to create awareness and being diligent at the very first place.
In recent case was during President Putin's visit, SR Oil signed a long-term contract with a Chinese Russian supplier.
Yeah.
That the market price was lower than the contract price.
Correct.
And within 3 months, even before the supply has started, market price is higher than the contract price.
Correct.
So in the case of commodities, one doesn't know future.
Correct. If I can draw a parallel from the, we also work on couple of this interest rate swaps, cross currency swaps. This is a 5-year contract. So in this case, at least the tax authority in transfer pricing are acceptable to the fact today, suppose in the 3rd year or 4th year, when you are paying the interest, should not look at the interest prevailing in that year, should look at the interest the day when the contract was entered into. Because definitely there are two people in a swap. How it happens? Somebody feels fixed rate is going to go down, somebody feels floating rate is going to go down. There are people with two different expectations. Therefore, they come and enter into a swap contract. Because each of them, the objective is to reduce their tax liability, their interest outgo. There has to be, for in a market, transaction to happen, people with two different perceptions. Today, if you are selling the share of Reliance, somebody has to buy it. And the person who buyer feels Reliance is going to go up. Person who is selling feels Reliance is going to go down. That's the reality of life. And therefore, it's very important from whose perspective you are looking at benchmarking, what timing you are looking at benchmarking. And in the interest rate swap, there are several examples where we are able to convince and show what you have to look at is the date of transaction, date of the contract, not the date of not the year of transaction.
So if we can have an APA including customs, then it will be really great.
It will be great. In fact, in the US, in China, Japan, if you go for APA, they ask you to submit the customs. When you go for SPB, they ask you to submit transfer pricing document. And therefore, I think because today you have to really show and demonstrate that I am dealing at arm's length. It is a very thin line. Today, for you to deal at arm's length, you don't mind upfront today tells you this is the price of 100, you get it 102, we'll hold it right. I don't mind doing it. But 10 years down the line, 5 years down the line, you come and say, no, its price 105 hona chahiye, whether my profit gets wiped out. And I then end up 10 years into litigation. And at the end of 10 years, again, what I see, tribunal is remanding the matter back. And again, I am going to start new. So, nobody wants. Today, if you upfront tell me $2 higher or 200 rupees higher, fine. I'd rather do it by peace of mind, get out of it. But then, that's what again, if you today go and talk to any of your client or you look at your own submission of your company and you see whether can you submit your customs submission to the transfer pricing, and you'll also get the answer over there. The questions are more or less similar, but the way the answer, responses are framed are so very different that today, whether you feel confident that this response will be able to save through.
No, but in those advanced countries, whether there is an APA involving TP as well as customs?
No. So again, customs is looked by the different authority, APA looked by different authority. So there is no convergence, at least that's one thing. We did about 10 countries we asked this question. How is the convergence happening in India? UK was only 1% that we have a similar department. Rest all the listing, and Switzerland has something different methodology only. They don't go with all this, they come with a maximum retail price and then they charge based on retail price. So there is no dispute over there in Switzerland. Other than that, none of the country there is a convergence. In fact, there is no country where the convergence there, both authorities are very in sync. It's not there. So look, that's what tribunal considered conclusion. No information furnished by SSC on a calorific value of a coal imported and other factors to distinguish it from coal imported by third party. And since if you don't submit why the price is different because of the qualitative difference, then how do you expect the court to rule that custom data should not be taken? Then he will take whatever data is done, he will upheld whatever officer has done. There are three very interesting case laws. In fact, in this Sinajin, here department substituted MRP, maximum retail price, which was there for import. Again, the facts of the case are very interesting over here. There is a Chinese head office. It has set up a branch in India. Branch is selling it to subsidiary in India. The price of the good is, original price is, let's say 20 crores. They are selling it to the branch at 60 crores. Branch is selling it to the subsidiary 72 crores. Subsidiary is selling it to distributor 80 crores. So original, which is 20 crores, becomes 80 crores when it goes to the distributor. And then distributor is going to sell to the product and the packaged foods. And when going to sell to the ultimate customer, the price is also going to be high. So much of margin in the value chain. And when 72 crores was the import price for the branch, customer was still not happy. No, 72 crores does not look to be right. If there is so much margin there, there has to be more margin into it. So they did the search and they kind of did so. They were able to in customs somehow able to get through and show. But when they came to transfer pricing, no, 74 crores, so much of margin you have made, there has to be more room for it. So that officer, he applied a mind, went to TIPS database, found out some comparables, trashed an adjustment of some, I think, 10 odd crores in this case, taking the TIPS database. Now the assessor was very aggressive. We went to DRP upheld whatever officer did. So today if you are buying at a 72 crores, like suppose they take an example, per unit price is 700 and the custom data is showing based on MRP price of 800. If that was taken, they went to tribunal. AO is upheld, TP department is upheld. What the madness is going on? If I am having such a healthy margin, still you are going to look at my transaction value and you are going to adjust me. And then they said like, so it's a very important finding. Second, where the meaning of specific term used has been legislated with a different objective in certain provisions, then the same cannot be blindly imported to income tax. MRP has a specific value, specific meaning, specific purpose. It cannot be blindly imported into the transfer and income tax legislation. And tribunal here passed out department. Very good order. If you read the order, the quality of arguments are superb over here. And they demolished and said what you are doing is incorrect. Today you are just taking an import price and you are comparing it. It's not correct. Because again there are food products, there are various quality, various categories and all those things. And they disregarded all those things and they upheld what associated them. They upheld the margin based. So we looked at earlier case law where tribunal has accepted what custom data was there. This is the case law where tribunal rejected. You apply application of custom data. So there is also already contrary view there. Fuchs. Now here it's another important. In a Fuchs case, SSC wanted to rely. SSC wanted to rely on custom data to justify transaction and tribunal refused it. Because there were also another issue. But this is a third interesting case. In first case, AO applied it, which was upheld. Second case, again AO applied customs, which was rejected. In third case, SSC applied custom data, which is rejected, saying customs and this cannot happen. And then fourth is where this is based on the TIPS database. There in Tilda Riceland, the important fact was the SSC has relied upon TIPS database to justify the values. The AO refused, saying that the TIPS database is based on the daily rate published by the custom authority. That is not comparable. The tribunal said, no, if TIPS database also, what it does, it collects the price of the third party transaction and it gives us average of that thing. Why should it not become? It's comparable. So they upheld the usage of the TIPS database, which is based on the custom value. So I have selected purposely this four various category of the case laws to give you the perspective, how much of there is no clear right or wrong. Everything you have to marry with your own facts of the case I have to build up. But then there are 4 case laws which lay down the different principles and which lay down the different how the tribunal looked at this 4 judgment depending upon the argument of the taxpayer.
How do you reconcile all 4? What is the way forward? Because they all give different way forward.
In next half an hour, I intend to give you answer of that. I hope to hear answer from you.
But they are so confusing.
Yes, sir. Therefore, sir, you cannot look things in isolation. You cannot look in isolation. You cannot plan in isolation. In transfer pricing, again, you cannot plan in isolation looking at India. You have to look at overseas also. You may say something is right, but is it right over there? Yeah, if it is not right over there, then better litigate. You may say something is right for customer, is it right for transfer pricing? So therefore, it becomes very complex and very interesting, and therefore it becomes important to be mindful since beginning, and not just to apply mind when 3 years have gone by and things have already water has flowed under the bridge.
Also, is it a big problem that the most of the global transfer pricing planning is done abroad? We are not involved in India.
Yeah.
And we are just there to implement or justify whatever has been decided there. So that would also be an issue.
Yeah, that will definitely be an issue because today, when globally they are deciding something, they have to not just keep India in view, they have to keep global things in view. But important thing is to understand the perspective. Rather than blindly applying it and bringing out the rationale into the Indian. So today many
is there a lot of modification happening to the global Indian perspective?
I think it is because India's share in turnover, global turnover is...
No, but India's share in litigation is very high, right? So that makes them concerned. I think the recent PwC study shows that.
So in fact, if you see, look, especially in ITES sector, a lot of the US companies, when they used to have a captive unit in India, they used to pay cost plus 10. That because they can't pay more than that, it's cost plus 10. Over here, the department is having cost plus 25, cost plus 30. So they got into MAP settlement. Then MAP happened, MAP was agreed at cost plus 80 between US tax authority and Indian tax authority. It was violent. MAP, mutual agreement procedure. Between two competent authorities was agreed 18%. So US tax authority went and gave an option to the US MNCs. I am going to allow you 18% payment for India. Why? Because the cost base, today if I compare the cost base in Europe, cost base in India, obviously cost base is lower. So I am going to allow you 18%.
Locational advantage was being taken.
Locational advantage factor. So 88% extra I am going to allow you, so you can deviate from your transfer pricing. While you may continue to pay other countries 10%, to India I am going to allow you reduction payment at the 18%. Now there were few MNCs, 50 odd cases which were settled at that time. There were few MNCs which accepted happily. Few MNCs said, bullshit. What 18% have you agreed? We don't accept it. We are rather better off litigating this case in the Indian tax tribunal and winning at 10%. We don't want to accept the MAP case of it. And they did not accept it and they litigated. They chose to litigate the matter. US IRS was so accommodating. They said, okay, fine. If you don't want to accept this 18% at this time, go back and litigate. After litigation, if you still want to come back and say 18% you want to accept, I will keep my doors open to you. So I am going to allow. So US, there is a flexibility got built in where they did allow and deviate. But Europe, especially Europe, you see, they will not deviate. European MNC themselves will not deviate and European tax authorities will not deviate.
I think Germany has not even allowed to get into this TP issues for their treaties. They're saying that it's
so they are not having this clause in a treaty which allows you to do a APA, bilateral APA. 9-2. There is not even a clause which is there. But gradually I think the discussions are open and they are trying to see whether in other articles we can bring, but still there is a lot of headway to be made over there. So in the US there is a flexibility there. In European MNCs flexibility is very less over there. But today when they are also selling about cost plus 5, again what cost components they are taking, how they instead of saying that 5% going to increase, can I make some proportionate adjustment to the cost over here? So can I make a cost like Mexico it allows, there's a maquiladora regime in Mexico where because of the huge fluctuation in foreign currency they said definitely I need to give regard to this thing. So can your cost, I will give you multiplying factor. Your cost instead of 100 I take 102, 1.2. So you are able to allow your cost to 102 because of this fluctuation in the. So this kind of mechanism can be worked out, which kind of allows you to find a midway path. common platform. So what has department done? Because of the commitment that even India would want to have a convergence between the OECD and the commitment that India will also have a convergence between the customs and transfer pricing. So they formed a joint working group. It was formed somewhere in 2008, and the committee was formed. There was a lot of excitement at that point in time. Things will happen, things will move, something will happen. A lot of commissioners. So there are 3 or 4 meetings happened between the customs authorities and the transfer pricing authority. They met, they said how was we going to do things. But after the initial euphoria, I think things are now slowed down. But when they met, they had listed down, this is what we are going to do. Cooperation and coordination between the 2 departments. Exchange of information in specific case. So a field officer from department will share the respective database relating to related party associate enterprise to each other. Familiarizing the concerned officer in both departments about treatment of transfer pricing in respective law through training and workshops. So few trainings were done, few initial conferences were held, but now I think the initial enthusiasm has died down and there is not much you are hearing. That's what I said 3-4 years ago. They used to have access to TIP database, they used to pull out data, apply it, give it, but nowadays I think this again enthusiasm, so it has slowed down. So while post facto they were applying to their advantage, if this is done beforehand and when you're planning stage and if you try to vary both the things, I think things can be done in a better way. So joint working group is still in place, but unfortunately the working group is not working. So it's that way at least breather at this stage. So
Income Tax Act we have section 92B, which is to have an intermediate party in between, still TP will apply.
yeah.
Do we have something like that in customs?
Yes. If there is a common entity which has a more than 5% everywhere, then also TP then will apply. So it's so wider. In fact, there was a control also, there was an intermediate party also. There was another slide, earlier slide was there. It's so widely termed that today we don't get into when we sit for a discussion of customs in any MNC, the first least thing which is easy to accept is how you are covered in this. Because there is, the ambit is so large, there is no way you can come out of it. And the litigation over there is quite tough, and to prove it, you are not covered is very difficult. And when you are doing your GAT valuation, there you have to tick. And once you tick that I am covered in related party, everything else falls in place. So, and most of the cases that I have seen, but 100% of cases, they end up saying that we are covered. There are hardly any MNC where they said it's group, joint venture, everywhere they said it's covered.
Suppose you appoint an independent distributor over here and give him a higher margin, let him import, and then he will sell it to a related party.
Yeah.
That practically doesn't work.
So then in that case, if you are having a distributor and distributor then selling it to a related party, look, it can work. Because today when you are importing in a capacity distributor, you are selling. So today what custom is concerned with when you are importing, there is, because of the price, there is no influence. Right? But today if your 100% of the contract was eventually meant for a distributor or the related party only, and then are you interposing this entity merely to circumvent the provision?
The deemed provision.
So then it will definitely, because there is in 90, that's what I said, 92B provision is there income provision in transfer pricing where it gets covered.
Yeah.
It's specific actually.
It's specific. Yeah. And now so they have extended to domestic also.
Yeah, exactly.
So this year is going to become my nightmare. You have a global contract to purchase a laptop or any facility management and all those things, and locally you are transacting. If this is identical in terms of this thing, then you both get covered. And if you don't report, 2% of transaction value is the penalty.
But customs, they have a specific provision like this?
I don't think specific. No, it's not there. It's not there. But these guys, they do a very in-depth analysis. Very in-depth analysis. When you take for SCB valuation, hardly anything that they will not ask for it. Though the questions are 29 if you saw, but each of the responses all will go in so much detail. And if already some structure is planned in a manner to circumvent the provision, then they will be able to see through it. Unless the CNA has a very good relationship and he gets through the things otherwise. But then it will come out somewhere, especially in transfer engine, it will come out only. And this comes out transfer pricing, then it will hit you hard in a customs.
What happens to the royalty payable by an Indian company to its parent company? How does it impact this royalty payment in my SPV?
Very interesting question. I think over here, we'll go back to SPV.
That's one of the 29 questions actually.
Yeah, one of the 29 questions. Amount of royalty, technical know-how fee, any other fee paid or payable by the importer to supplier of the imported goods. So they ask you, okay, you're buying this bottle at $10, fine, agreed. After you buy this, are you going to pay royalty? And you say, yes, I'm going to pay royalty. How much? $2. Great. Then the value of your SUV purpose will be $12. Because this is the purchase price you are paying in other form. There is a thin line to distinguish. Is my royalty payable when I do an eventual sale? Only if I sell the royalty is due, or royalty is due if I buy the goods. If it's linked to the royalty is due if I buy the goods, then they will levy. If you say it's based on the sale, then there are judgments to say that that will not be covered because it's contingent upon the sale and the product may not eventually get sold and everything. And that's why FP valuation shame should not be taken. But the onus is on you to prove $10 first of all was harmful.
If the royalty is paid to another royalty, they import from China and they use the trademark of UK company itself.
Then you can still distinguish, look, it is not a part of the manufacturing cost. So today this royalty I am actually paying for me to enable me to sell, it is not price of the procurement. It's not price for the goods I purchase. But generally their starting point, whenever they see a royalty, they ask you royalty, you want to pay the royalty. Their thing is I want to load this royalty into the price of the goods. And this is one very grey area of dispute between the customs and the practitioners. Very good point. So I think before we get into 10AA, I think the answer to the point, can they both converge? I think look, the rules and regulations today are there makes it difficult to converge transfer pricing and customs. What as a taxpayer or the practitioner, what we should be mindful of? We should be mindful of, at the inception stage when you're doing the planning in a manner that you develop your argument in such a manner that it's palatable from both jurisdictions. There are flexibility available. Like in transfer pricing, flexibility available is the 3%. So if 3% flexibility is available, then you can do it. And a very interesting example we will do, when as a distributor you can justify the price as a cup, but you can differentiate different margin because you are having an incremental functions in a transfer pricing process. So I think those are justifications should flow in your SVP, should flow in your transfer pricing documentation. Even if it was to be taken, it was to be adopted, that it marries out this thing. So at least from taxpayer perspective, as much as uniformity and consistency you make in both the submissions will be helpful, because it's just a matter of time, everything getting automated. And the already effort made for both the authorities to converge and to exchange information. So it should not happen that once the information is getting exchanged, you are worse off. So today let's not, it's a fait accompli, we'll see when it happens. Because it's going to happen. And by the time, each case, once the addition is made in your case, it's going to take at least 10-12 years for you to get a resolution. And within the 10-12 years, if the tax authority is able to find this and strengthen their arguments in a tribunal or this thing, you again will be like where you will be faced with that. So planning at a inception stage, or even while you are giving a submission to both the authorities, very important that the tax, direct tax and indirect tax teams, they work in conjunction and not work in isolation. You should not this hand what he is doing, he doesn't know what here is happening. Many times I have seen the company has a rule. I don't want indirect tax team to talk to direct tax. Because no, we are getting it through done to CNF agent. If direct tax people will come and talk to them, they will influence, the submission will be diluted. Historically, we have never had an addition in a customs. By getting these guys, we are going to spoil the thing. I practically am seeing a large MNC. They are not letting us talk, they are doing an APA. They are not letting us talk to the indirect tax team. They are not letting us see their SVB. No, very confidential, we can't let you do that. What's their motive? God only knows, or they only know. But that's a practical fact of the life.
Ramesh, one more practical issue which we find is that besides the interaction between the two teams, the litigation happens few years down the line.
Yeah.
Now in the current scenario, there is a huge churn at all levels in our country right now.
Correct, correct.
Not only in India, abroad also.
Yeah, yeah.
And in the olden days, at least we could trace the physical file and documents are there in the file. Now nobody takes a print out, everything is taken
Online.
on email. The moment the person goes, and even the laptop is also changed every 2-3 years. So the whole data is gone.
Yeah, yeah.
Now, except the only common factor is the consultant. So now finding the documents also is very difficult, and now even at consultant levels also before there is a huge churn.
Yeah.
So when the litigation happens, by the time the matter reaches the tribunal, so there is no trail at all.
In fact,
Everybody throws up the hand.
and that's what today, unfortunately, really data to data management has become a key. Nobody, because and again the reason is the MNCs also want to shrink the staff. There's the one hardly you see in a direct tax indirect team. Today, if the need of 10 people, there will be only 4 people want to go. And the 4 people will be so overburdened with 4 things that he hardly has the time to do things. But one good practice which I have seen happening in the couple of MNCs where I have seen that they have made it a rule not to exchange information through email. So if you want anything, I will have a common platform, web-enabled platform. Anything and everything you have to do through that. So today, if you want to access my agreement, you tell me, I will tell you which is source, but the agreement will be placed over there. And everything is so sequentially numbered and all those things. And I think as a heads off to them, they have spent a huge amount of time and effort in building their platform. But today the platform is such that once you get half an hour, 1 hour to familiarize this thing, and everything is stored over there. They are dealing in more than 100 countries. It becomes humanly impossible otherwise. All they are transferring, benchmarking, all their agreements, invoices, all they are trying to map their SAP system with that so that everything gets captured. But this can be also done in a small platform, small based manner where things can be done. Because now with this, I think 4 years ago I know scanning a document used to be task. Now it becomes very easy. Scanning document and having it regularized form. And that's one of the key challenges if you continue to face, and then there is a lot areas there to improve upon.
And now digital invoices are being allowed. So
Digital
even invoices will disappear from papers.
Now specifically in the exercise there is a service tax amendment.
Yeah, exactly.
All these things digitally is allowed. And then people are involved.
Building up a proper filing system is, I think, a key. You have a web-based system which is fine, but smaller companies, it may not be possible. They might not have the infrastructure.
In fact, I went last year to our UK office. The UK is one of the larger practice we have in transfer pricing. Here in India, we have 350 people. In UK, I was surprised that hardly it's a practice will be 3 times more than what our practice is, revenue numbers, and they only had 40 staff of 40. And when I saw their office, literally there hardly any file, hardly any paper. Completely working on a paperless work. Completely paperless work. So I think those countries have taken steps and matured to a great extent. I think here, today you look at unfortunate DRP. When you go to DRP, they ask you all submissions, all agreement, everything, and you make a 7 sets and you send it out. And when you go and see to their office, your submission will be lying somewhere outside the corridor. And anyone can tomorrow go and pick it up and use it. So all these things are lying attended. In fact, last year we got a letter from them, okay, your 3 extra copies are left, you can please take it back. We were so happy. At least this thing will be able to use in a tribunal. And this year at least one DRP secretary is sending a notice, you only submit 1 copy at this stage. 2 copies you carry at the time of the hearing. But the unfortunate ground reality is that our tax authority, unless they see paper and the piles of paper, they are not happy and they don't want to do this thing. But there are few, at least at the officer level, I have seen things, they are accepting things in CD. They are accepting. In fact, large volume data, if you say that, okay, whichever papers you want, I will take a hard copy and other thing I will give in CD. A lot of officers are now actually getting more tax savvy. If you see, go on there, they are very fancy Apple laptop lying over there, and then they are browsing things and all, and they are quite happy to kind of, things. They are way to catch, but things are improving there, I think. But document management and retrieval, today there is a problem which each and every MNC is going to have. And this is one of the, even the problem is least is neglected one. Nobody today tries to have it. So one of my case, there is a CID appeal submission. The case got transferred from other Big Four. Neither do the Big Four has a CIT appeal submission, neither tax department has submission, neither the assessee has submission. We are before tribunal and we are struggling now what to do. The CIT submission we don't have. Okay, so application to 10AA. Transfer pricing is anti-abuse provision. You cannot take advantage. So they were saying, okay, if my profit is exempt, what's the point? Let me charge 20%, 30%, my profit is exempt. So therefore, let me charge profit. Okay, let me explain the background to everyone. So in 10AA unit, what happens once you set up a unit in SEZ, your profit for the period of 15 years, you can choose the option of 5 and 10 years, are exempt for period. So today, if you are having a captive back office processing unit, the profits are exempt. Generally, typically, a captive unit charges a markup in the range of 15 to 20%. Tax authority is asked 30%. So when your profits are exempt, how does it matter? Let me charge 30%. The profit is anyway exempt. So few people at the time of return, because of group policy, you cannot have money more than 15% coming from them. They made a suo motu adjustment in the return, and they said, yeah, we have offered additional tax, so that will be accepted, that will be done, and that's it. When they went to tax authority, they said, no, this is not done. You should have entries passed to the Musab account. If you do a self-adjustment, you come to me saying you are offering extra, and anyway there is no tax outgo, I am not going to give a benefit of that. That goes on. They made addition of 30%. Once they made addition of 30%, the arguments were taken before the tribunal. Then this profit should be exempt. So the 30% anyway, there is no intention for me to shift profit out of India. But then they brought in the specific provision to say that if you are a tax holiday and if transfer pricing adjustment is made in your head, then on that addition, deduction will not be. So I want to punish people who are not transacting at arm's length in first place. So because officer made so, and then you cannot come and take an argument, anyway my this thing was exempt, and therefore there is an anti-abuse provision where they said any addition is made, either I will give you a tax holiday on this, and neither I will give you the corresponding benefit to other entities. Suppose you are paying a royalty, and you are paying a royalty at 10%, and transfer you are paying royalty at 10%. Royalty is tax based on source country. So the foreign company is also filing return of income and offering the 10% to tax in India. Now officer says no, 10% is not right, 5% is right. So officer is disallowing 5% in the hands of the Indian company. Then can foreign company go and reduce its income by 5%, saying you only said 5% is arm's length, so you also tax me at 5%. So no, we will not even allow correlative adjustments. What is correlative adjustment? If you make an addition or deletion in the hands of Indian entity, we will not pass on the benefit in the hand of the foreign company. And therefore, in a 10AA situation also, while there is, if you plan it out in proper manner and you offer incremental income, there is no tax outgo in your hand. You could very well do that. But then when you try to do that, there are problems, because if you want to offer more income, you want to charge more to parent company. Parent company, will it get deduction in that year in those companies? Because they will face a difficulty. They are tax authority not going to allow 30%, 40%. So even though there is a specific exemption given that your profits are not taxed, you cannot, the ability to offer incremental income get restricted over. Domestic transfer pricing. So the limit was 5 crores till March 15, now it's going to increase to 20 crores. In that there is specific provision, if there are two units, one is tax holiday unit and non-tax unit, if there is transaction between them, it will get captured in a domestic transfer pricing. Because generally people have used to push larger cost or a lesser income into the tax holiday unit. So there are these two cases which are relevant over here, Tweedsman and the Western knowledge system, where in fact it was also in context of ATI at 10, where there was a more than ordinary profit. So there was a taxpayer who was earning 40% profit in India. And the officer did a search and said, no, only 15% should be allowed as more arm's length. Since you are having a tax holiday, you are offering more income in India. So I am going to disallow your claiming extra deduction. So the then the tribunal over there held, it cannot be disallowed. If taxpayer has legitimately planned a business and earning 40%, just because tax holiday is there, I will not disallow it. So very good case law in that sense.
regarding the fact that if the taxpayer itself has enhanced income voluntarily, then I think there is also a decision, I think in case of IGATE, it said that if you yourself are enhancing, then you can claim reduction. If the officer enhances, then you cannot get it.
No, so that was, I get gave decision on that, but a lot of people planned. So a lot of these 10A units, they said, let's make a sumo adjustment. So subsequently, I think it all got overturned. I get the facts were different. So there again, before the scrutiny came, they had enhanced, and then there was some background also. So I get it was fine. But after that, a lot of people started applying that I am anyway 10A unit. Let me offer 10% more. How does it matter? Because I don't have to get the actual money out over here. And all of this, so we in fact started selling that product so well. And then all out got backfired, and now things are again come to this thing. If merely making a sumo adjustment, you cannot take benefit of it.
So there are again between after IGATE.
Yeah. Corporate governance. Multiple laws, multiple compliances. Day by day compliances are increasing. At least few things I can think of about Income Tax Act, Companies Act 2013, SEBI norms. So Companies Act 2013 has actually changed the life now. It has changed the life in terms of whatever was responsibility has become accountability. Whatever the accountability has become more onerous, and in fact the personal imprisonment, or confiscation of the people is what is making things very difficult, and holding a key managerial position in any of the company now is become so vital, because anything we to do with somewhere, you are going to be held personally responsible for, and job of independent director again has become so difficult. So just touching on to, we spoke about domestic transfer pricing, which are in 48 always was there in an act, and any transaction of between the goods of a tax holiday and between tax holiday unit and other unit or group company is always covered is now covered in transfer price. So you have to justify arm's length over there. In Companies Act, all transactions with a related party have to have the audit committee approval. So you have to go approach audit committee, state what are the transactions taken approval. If your transactions are not at arm's length, or if it is not in ordinary course of business, you have to take a board approval from board of directors. If transaction crosses certain threshold, like today, if the purchases are to do is more than 25% of your turnover, if the assets are below certain threshold and all, you have to seek the shareholder approval. Again, in the shareholder approvals, so there are 3 layers of approval in the Companies Act: audit committee, board approval, shareholder approval. Audit committee, by default, all transactions. Board approval only if it's not in ordinary course of business. What is not ordinary or ordinary not ordinary? Today, if you are a company manufacturing mobile handsets, and if you are selling a property, that is not an ordinary course of business. If that property is more than 25% of the net worth, then it's not an ordinary course. You have to take a board approval for the transaction. And third is shareholder approval. If they have specified various thresholds, if it crosses threshold, then you have to go and seek necessarily shareholder approval. All of the approval has to be in place beforehand. If all of this is not there, auditor is going to inspect, and auditor is obliged in his report to report non-compliances. Auditor is also supposed to report all these non-compliances to Ministry of Corporate Affairs. So therefore, complying with related parties in a corporate setting has become even very important. Let's go one step further. One step further is a listed company. So while the Companies Act anyway have to comply, when I come to the SEBI, SEBI has another itself made a various changes, various threshold. In fact, there was so many representation made to SEBI. Why are you twinkling with the definition of related party? Today I have become so difficult. In SEBI, when the draft regulations were there, if there are 2 joint ventures, and if they are transacting with the entity, both the joint venture entity were considered to be related party. So this was unheard of in a AS18, Income Tax, Companies Act, so difficult. Fortunately, they heard the representation, and now in a SEBI, at least they have aligned the definition in line with Companies Act. So as per section 276, whatever definition of related party is there, good, that the same definition is there even in the in a SEBI in line with Companies Act. What does SEBI wants? SEBI wants, again, all approvals should go through an audit committee. That's what SEBI wants. What does SEBI further want? SEBI further wants is, if there are material transactions, you need to have the special resolution. Okay. What are the material transactions? You again specify the limit. In a special resolution, is there a deviation from the Companies Act? Yes. What is the deviation? In a Companies Act, concerned related party cannot transact. Suppose you have 10 related party. Out of that, you are transacting with 2 entities. So 2 entities interest is at stake. So only out of 10, 2 cannot vote. 8 can vote, even though they are related party. When you come to SEBI, SEBI says, whenever you are doing a group transaction, it's a material, I will abstain all related party from voting. Companies Act says, I will only abstain concerned party from voting. SEBI says, I will abstain everyone from the voting. So only minority shareholders will be having a say in whether to transact or not transact in a related party setting. So lot of complication, because this has actually become so difficult when you have a 80% promoter holding and 20% domestic people. So at that point in time, those people getting a say and stalling any development which is there. It's become, in fact, there are a lot of news articles. A lot of listed companies' names have been, whether selling the business and all those things, have got stalled because of this. You are allowing only minority shareholder to vote in these. So corporate governance, again, equally very important. And again, you cannot do anything after the water is thrown to the bridge. It all has to be done beforehand. Approvals have to be in place. Not having these approvals is a personal responsibility of all key management personnel. I think a lot of awareness is created, but still, as a way to catch up in the corporate governance. I think we are already through with our time. So, thank you. If there are any questions which are there, which are not answered, not this thing, my email ID is there, please write to me, reach out to me, happy to address, happy to have a discussion. Yeah? So if you have any questions?
Yeah. If you have any 1 or 2 questions, you can ask us now, or otherwise you can take it offline.
So at least those 5 questions which I have answered, let's see whether we have the answer to them. Will the conversion between customs and transfer pricing method be beneficial to taxpayer? Look, if conversion does happen, it will be beneficial because it will reduce the agony and pain of meeting the officer and having the difficulties and all this. If it's consistent, rules are consistent, it will simplify. And with the Make in India theme and we want to simplify everything. Yeah, in theory we say it's definitely beneficial. In practically you need to see how it's getting implemented. Are method prescribing custom rules and transfer pricing similar? Yes, they are similar. Whether taxpayer has to adopt the same method justify arm's length nature of its transaction, we discuss one practical example. It's possible to take a different method provided your justification. But ideally, answer has to be, can there be situation where both customs and tax authority make addition to the same transaction? There are numerous such transactions where both authorities make addition to the same transaction. Can taxpayer rely on benchmark analysis conducted for tax purpose during transfer pricing assessment? Yes, why not? You can rely upon it. But if there are differences, you need to iron out and line out differences. Both authority can rely upon this thing on the any submission with them. Right? Yeah. So thank you so much.
Thank you, Bhavesh, for dealing with this subject very, very practically and making it interactive. May I request Jay to propose a vote of thanks.
Respected dignitaries and dear friends, good morning. The speaker and his enthusiasm set the energy for the session right at the start. He took us through the custom law, the transfer pricing law, the rules, the fine differences, and even he took us how, if the conversion happened, what will be the impact of it. I think at the start of the session he gave an example of green world, and by the end of the session he has given us the green specs. When we leave, it's up to us whether we wear it or we do the other way. I request everyone to join us in giving him a big round of applause. We will just take a short break of 10 minutes and we'll start with the other session. Thank you.
We have one or two seat if they can interact with the things. He has no way.
You alone?
Yeah.
Alone? Office?
Yeah. I think I attended the previous ones, the 3 or 4 of them. I like it.